Welcome back to the deep dive. Today we're really taking the microscope to Target. We're going to dig into their Q3 2025 results.
And it's not just about the numbers on the page. We've got the official press releases, the financials, and our mission here is to sort of pull out the real strategy.
Right. What are they betting on for the future?
Exactly. Can their big plans actually get them back to, long-term growth? Because the consumer economy out there is, well, it's pretty shaky.
And you see that tension right away in the top line numbers. Net sales, they were down 1.5%, landed at about $25.3 billion.
Which, if you just stop right there, you'd think, uh-oh.
Yeah, it looks like a real struggle. But the company's context is key here.
It is. They said this performance was, and I'm quoting, in line with internal expectations. So they saw this coming. They knew it was going to be a tough quarter.
Because people are just pulling back on the non-essential.
Right. But the pivot point, the real saving grace in this whole report, is the strength they showed in their digital channels. That's the story we have to unpack.
And this all comes as there's a big leadership change. Michael Fidelka is stepping in as the new CEO, and he's already laid out his roadmap.
Yeah, he's got three big pillars. First, solidify their merchandising authority, basically be the place to go for certain things.
Okay.
Second, elevate the shopping experience, in-store, online, everywhere. And third, and this is maybe the most important, harness technology.
To make everything run better.
Exactly. Drive efficiency, drive personalization. And these aren't just buzzwords. The rest of the report really shows you where the money is going to back these three goals up.
Okay, so let's get into that data. Let's start with the core metrics.
Let's do it.
The big number that really measures how shoppers are feeling about Target is comparable sales. And that was down 2.7%.
But that single number, it's almost misleading because it hides two totally different realities inside the company.
Right. The physical stores versus online.
Exactly. The real pain point is in the buildings. Comparable store sales, they fell by a much steeper 3.8%.
And that points directly to the discretionary stuff, right? The clothes, the home decor.
The things you still tend to browse for in person, people just aren't buying as much of it.
But then you have this fascinating counterbalance. Comparable digital sales, they actually grew by 2.4%.
So the customer's still shopping at Target, they're just, changing how they do it drastically.
So if you put those two things together,
yeah,
how do you get to that overall drop?
Well, it comes down to traffic and basket size. The overall decline was driven by a 2.2% drop in the number of transactions. So fewer trips to the store, fewer clicks online.
Okay, fewer visits.
And a 0.5% decrease in the average amount people spent. So people are being really careful about how often they shop and how much they buy.
And within that digital growth, there's one specific thing that's just exploding.
Oh, yeah. The real success story is all about speed and convenience. The digital growth was led by, and this number is just staggering, more than 35% growth in same-day delivery.
35%? Wow.
And that's all powered by their loyalty program, Target Circle 360. It just tells you that when people need something now, that convenience is the thing they value most.
Okay, but let me play devil's advocate for a second. If store sales are down almost 4%, isn't that massive physical footprint becoming a liability? You flagged a number here that 97.7% of all merchandise fulfillment still involves a store.
That is the essential question. It's a huge strategic challenge. The store is now the fulfillment engine, but it's not a great sales engine, at least not for the high-margin stuff.
So they have to manage the costs of all that real estate.
While at the same time using it as a mini distribution center to feed this booming same-day delivery service, it's a tightrope walk. If store traffic keeps lagging, the cost to keep that fulfillment system running starts to look really heavy.
In other words, the store is providing a service that a giant warehouse can't. But if they're not selling enough throw pillows while you're there to pick up your cat food, the whole model gets squeezed.
You've got it. The success of same day has to eventually bring people back into the store to buy other things, or the economics get tricky.
So let's talk about what people were buying.
Right. Let's look at the actual segments.
The essentials were obviously the winners here.
Absolutely. Two clear leaders. Food and beverage, sales were up a bit to $6 billion. And hard lines, that's, electronics, small home improvement stuff, that also saw some growth.
People are still stocking their pantries.
And making those small necessary purchases. But the pullback elsewhere was pretty stark.
Where did it hit the hardest?
Just where you'd expect. The discretionary categories. Home furnishings and decor, Sales fell by almost $300 million.
Ouch.
And apparel and accessories saw a big drop too. It just confirms what we're seeing everywhere. When people feel uncertain about money, those are the first purchases to get delayed.
Okay, so that sounds like a recipe for disaster on your profit margins.
Huh.
But like you said, they met expectations, and this is where we have to talk about the hidden growth engine.
This is, I think, the most fascinating part of the story. This is where Target is becoming a totally different kind of company. Non-merchandise sales. They jumped almost 18%.
18%. What's in that?
It's driven by three things: their digital advertising platform, which is called Roundel, then membership revenue, and marketplace revenues.
Let's focus on Roundel for a second. An ad platform inside a retailer. Why is that so valuable? Why is it such a good shield against this other pressure?
It's all about the data. Roundel is incredibly valuable to other brands because Target has first-party data. They know exactly who you are, what you bought, when you bought it,
From the Target Circle app.
from Circle, from your purchases. And that lets other brands target ads with, surgical precision. It's a much cleaner signal than what you get from, say, a social media platform.
And the margins on that must be incredible.
They're huge. They're basically just selling access to their customers. The operational cost is tiny compared to the revenue. It's a powerful profit shield.
So they're selling the attention of their shoppers just as much as they're selling laundry detergent. And that helps explain why their overall gross margin rate only slipped a tiny bit, from 28.3 to 28.2%.
Precisely. That tiny slip is masking two huge forces pushing in opposite directions. On the one hand, they had to do a lot of markdowns, slashing prices on clothes to get them out the door. That hurts margins.
But on the other hand,
On the other, you have that high-margin ad revenue from Roundel, plus they got more efficient in their supply chain and had less inventory shrink. Without Roundel, that markdown pain would have been much, much worse.
so have they just built a firewall, or is this just papering over a fundamental problem with their core retail business?
That is the big strategic question. For now, it's helping them ride out the cycle. But going forward, if those discretionary sales don't come back, the Roundel platform has to keep growing like a weed to carry the weight. It's a clever pivot, but the stores have to stabilize for the whole thing to work long term.
All right, let's move down to the bottom line. Earnings per share. And the numbers here need a little bit of explaining. The main GAAP number was $1.51.
Which looks like a pretty big drop from $1.85 last year.
It does. But that's not the whole story.
No, the number to watch is the adjusted EPS, which came in at $1.78. Still down a bit, but that 26-cent gap between the two numbers, that's all from what they call business transformation costs.
Good. What does that mean in plain English? Are they just one-time write-offs?
Pretty much. It's money they're spending on a big multi-year plan to streamline the company. So severance packages as they restructure, charges for getting rid of old technology, they're basically spending money now to save money later.
But it makes the main earnings number look worse in the short term.
It does. But it shows they're serious about this restructuring, even when revenue is tight.
And that desire for efficiency brings us to another metric, return on invested capital, or ROIC. That declined to 13.4%.
Which is pretty natural when you're in a heavy investment cycle and sales are soft. It just means the capital you're spending isn't generating the same immediate return it used to.
They're planting seeds rather than harvesting the crop.
That's a great way to put it. And it's important to note there was a one-time benefit in there from some interchange fee settlements that propped up the number a bit. Without that, the decline would have been a little steeper.
Which brings us to their investment plan. Despite all this pressure, they're actually hitting the accelerator.
This is the biggest signal about their future strategy. They plan to invest an additional $1 billion on top of their normal plans to improve operations and experiences.
They're not retreating.
Not at all. They are doubling down on those three priorities the new CEO laid out.
So how does that $1 billion connect back to those goals? Merchandising, experience, and tech. What are they buying with that money?
You can connect the dots pretty easily. A lot of that is going into technology. Think about more automation in the back rooms of stores to handle all those same-day delivery orders faster. Think about AI to personalize the website, to show you the right products, to, boost that merchandising authority.
And the shopping experience.
Better self-checkout, making the app work better inside the store, and just continuing to pour money into making that drive-up experience the best in the business. That's their competitive edge.
So it's a very clear signal. They're willing to sacrifice some short-term profit for what they see as necessary long-term improvements.
Absolutely. They're taking the margin hit now because they believe if they don't invest in tech and convenience, they'll be in a much worse position against Amazon and Walmart in a few years.
Okay, so with Q3 in the books, all eyes are now on the holidays. How is Target setting up for Q4?
Their whole holiday playbook is built on three words: newness, convenience, and value.
Let's start with newness.
The scale here is kind of mind-boggling. They're offering over 20,000 new items for the holidays. That is twice as many as last year.
Twice as many. Wow.
Yeah. And they're leaning hard into exclusivity. More than half of those new items you can only get at Target. They're betting that if you can't price check it on Amazon, you're more likely to just buy it.
That's a huge operational lift. And they're pairing that with some extreme value on the other end, right?
It's a classic pincer movement. They're defending their market share on essentials with these really visible deals, like a Thanksgiving meal for 4 people for under 20 bucks.
And I saw turkey for 79 cents a pound.
Right. That's a loss leader. That is a statement designed to get you in the door or onto the app. And once you're there for the cheap turkey, they're hoping you'll grab a few of those exclusive toys under $20.
So the strategy is hook them with value on the things they need.
And then surprise them with affordable, unique things they want.
And all of that is wrapped in convenience.
Always. They're expanding next-day shipping to cover more than half the country on top of the drive-up and order pickup that people already love. The message is simple. We have what you want at a good price, and you can get it however you want it.
So what's their guidance? Do they expect this holiday plan to turn things around immediately?
They're being realistic. For Q4, they're still expecting a low single-digit decline in sales. They know the economy isn't going to magically fix itself by Christmas.
But what about the earnings?
The full-year adjusted EPS guidance is holding steady, around $7 to $8. And that stabilization, even with falling sales, it just proves how effective their cost controls and, most importantly, that high-margin round-o growth really are.
The long-term plan is moving forward, even if the short-term sales are still feeling the pressure.
That's the story of the quarter.
Okay, so let's wrap this all up. What are the key takeaways for you, the listener? Target is clearly navigating a tough spot. You've got lower traffic and big markdowns on the stuff people want but don't need, like clothes and home goods.
But, and this is a huge but, they are actively fighting that by pouring money into their other businesses. Specifically, the high-margin digital ad platform, Roundel, and membership fees. That's what's offsetting the pressure from traditional retail.
And looking forward, their strategy is clear. It's defined by a massive $1 billion extra investment in technology and convenience.
Right, and a holiday plan that's all about pairing extreme value on groceries with thousands of new, exclusive, and affordable gifts.
It's a complex picture.
It is. And if we connect all these dots, it brings up a really provocative thought for you to consider as we finish up. Given that Target is now actively using advertising revenue from Roundel and membership fees to keep its profits stable, should we really be analyzing it as just a traditional retailer anymore?
Meaning?
Well, are they still just a company that sells stuff off shelves? Or are they quickly turning into something else? A hybrid media and fulfillment company, where the profit comes just as much from selling access to their customer data as it does from selling the actual products those customers buy. That evolution could fundamentally change how we value a company like Target down the road.